Thanks, Philip. Bart Greenberg, Pivotal Law Firm, a firm I founded about, in 2016, after being at big law firms for 26 years. My practice essentially worked in the representation of entrepreneurs, startups, emerging technology companies. And, during that representation, typically worked with our clients and getting them formed and organized, getting them squeaky clean if somebody else did that. We work with them on their early stage financing, typically friends and family, angel, venture capital, and then up through private equity and debt financings for our more mature clients. And we do, most of our clients tend to have their exits be M&A, so do a lot of M&A, both consolidating on the buy side and a lot as the exit on the sell side. And then a whole lot of stuff in between, including equity incentives to the team members, which is what we're going to be talking about today. So let me go ahead and share the screen and get my presentation up. And the way I like to run the presentation is to make it, entirely interactive. It's a little bit more of a challenge doing this through the Zoom, but, raise your hand and, maybe Philip, you can help get the questions to me if I don't see the hands up. And so it looks like it didn't go to full screen yet. There we go. Okay, you can all see it now, right? Okay, great. So again, feel free to ask as we go through. This is a condensed version because I usually spend a longer time here, but I've kind of picked out what the most important things, at least about thinking about this. Typically when I do the presentation, I do a whole lot of like touchy-feely stuff up front, kind of, design, plan, what you're trying to achieve. And we'll touch upon some of these things through the presentation. So I'm just kind of skipping over that stuff just in the sake of time. But the one that I really want to kind of emphasize here is that equity incentives is really what I call a compensation gap filler to a certain extent, right? I mean, the typical client startup emerging technology company's goal is to attract and retain talent. It may not be in the position to pay a market competitive salary, and it uses equity incentives as a gap filler, right? To fill the gap between what they're willing to pay and what people perceive to be the market. And obviously the hope is that by working hard, will make the company advance. And then they'll be rewarded in the company through an exit or some other event where they'll be able to cash out through the equity, right? So that's kind of the basic premise here. I'm going to talk about three types of way of compensating the team through equity or equity-like devices. We are going to spend a lot of time on the first, a little less time on the second, and we're going to move really fast through the other end. What you're going to see is a lot of the concepts are going to be repetitive, and so we'll be able to kind of keep moving quickly through the presentation. So let's go ahead and move forward to direct stock purchases. So what I mean by a stock purchase is it doesn't necessarily have to be a purchase, but what I'm talking about here is, where someone basically holds up that certificate which says, Bart Greenberg is a certified holder of X numbers of shares of XYZ Corporation, right? It means that I own a piece of the pie. I own equity in the company. I am a stockholder. I'm an owner. And typically through the employer, employee, or consultant side, this is done through a purchase, allowing someone to buy into the equity, but more typically done through a stock grant, right? Giving somebody either stock when it has very little value, or the option to get stock as they come in, even when the companies are more mature. And we're going to talk about some of the issues. So when it comes to giving stock, in the slides I talked about eligibility and participation, and what I mean by that is who can get these things, right? And when we talk about giving stock, actual stock to people, it's typically an individual-based approach. Okay, that means it's typically a one-off deal that most companies are doing. It can be broad-based, right? A company could have, for example, a stock purchase plan where they basically attract a wider pool of employees. And what we'll find out, is basically it's a little bit more difficult to do broad-based when you're actually giving stock. We tend to see these broad-based plans more common in stock option plans. So there's two key types of grants that I want to talk about, and they have different ramifications from tax and other things. So the first type of grant is what we would call unrestricted, okay? And what I mean by unrestricted is that the stock is not subject to any risk of forfeiture, okay? I don't mean that you may not be forced to give it back, right? So for example, it could be that when you leave your employment, that the company has the right to buy back your stock. The point here is that it's not subject to risk of forfeiture, because if you have to buy it back, the company is going to give you full value for it, right? So you're not losing anything. You're not forfeiting value. Okay, you may be forfeiting the stock, but it's not what the IRS would consider to be a risk of forfeiture of value. Okay. In contrast, some stock grants will be restricted. Okay. Restricted grants are subject to a forfeiture. Okay. That means that when you leave the company, it could very well be that you're forced to give back the stock and you're not going to get cashed out at fair market value. Okay. So you are going to lose the value of that equity, mostly because you didn't earn it. Okay. And we'll get into more detail on that soon. So again, it's important to know the tax treatment, because a lot of employers make big mistakes, in incentivizing their team members. And what they do is, rather than incentivize people, they disincentivize them because they cause big tax problems for their employees if they don't do this correctly. So when we're talking about an unrestricted stock grant, okay, one that's not subject to a risk of forfeiture, the recipient has ordinary income to the extent that the fair market value exceeds the purchase price. Okay, so let's do some math here, right? So let's say I'm getting one share of stock worth $100. If I pay for $100 for that, I don't have any ordinary income, right? Because the fair market value equals the purchase price. But if the employer was giving me that stock, in other words, I wasn't paying for it, then the fair market value is exceeded by $100, right? In other words, my cost is zero, the fair market value is 100, and that stock grant is going to cause me, the employee, $100 of ordinary income, which is going to be taxable at ordinary income rates. Now, because the employee is recognizing the ordinary income, the company is going to have a compensation deduction, right? So this is a way that a company can reduce its taxable income and not pay as much taxes. The problem is you're disincentivizing your employee pool by having them, have a taxable event. Now, regardless of whether this is a taxable event at the date of grant, once the stock is sold or liquidated, the employee, if they've held it for a year, will have capital gains based upon the difference between the value they received the stock and the value of the sale price. So again, let's go back to the example where I received one share of XYZ for $100. If the company exits and that share is now worth $1,000, I'm going to have $900 of capital gain, okay? And it will be taxed at the lower capital gain rates. And I say lower because typically and historically that's true, but it's not always been the case. Now, it's a little bit different for restricted shares, okay? In restricted shares, when a person receives restricted shares, it is a non-taxable event. It doesn't matter what the value is. Because the shares are subject to a risk of forfeiture, the IRS considers you as having received nothing, right? There's no value if what you have can be pulled back and recaptured by the company without giving you any value. Then, as and when these restrictions lapse, that's when you recognize the ordinary income. Okay, and so this is what you guys probably have heard of as founder vesting, and so founder vesting is typically restricted shares. And it's very typical when you get founder shares with founder vesting that those shares, for example, vest, or they have to be earned over time. So let's say you receive 500 shares, they vest 25% a year or 20% a year, just to make the math easier. In other words, 100 shares a year. In 5 years, you will have been fully vested, right? So year one, 100 shares are now not restricted, where 400 remain restricted. Year two, you now have 200 that are no longer restricted, and 300 are restricted. Okay, so I think you guys are with me, hopefully. Now, the issue is that you're going to recognize ordinary income, you meaning the recipient, okay, as and when the restrictions lapse. So at the end of year one, let's say those 100 shares, which were originally worth $100, are now worth $1,000. You then have $900 of taxable income. Okay. Year two, another 100 shares have vested and have been earned. And let's say those shares are now worth $1 million. Okay. You now have $999,900, right, of taxable income. So that's a really bad day, right? And it gets only worse. So in other words, for a company that is accelerating and growing rapidly, giving somebody restricted shares can cause a terrible tax problem over time as those shares increase in value. The solution to prevent the hardship of that is something that you guys have probably heard of, which is the 83B election, okay? It's called an 83B election because 83B of the tax code provides some relief. Everything we've been talking about so far is 83A, right? 83A is what says that you recognize income as and when the restriction lapse. 83B is what helps you out. So if you make an 83B election, which you really should, if you're receiving shares that have little to no value, okay, and there's a potential for them to increase in value over time, you can make an 83B election. The 83B election basically says, hello, IRS, I've received 500 shares of XYZ Corporation. And what I want to do is I want to recognize the value today, even though they're subject to a risk of forfeiture. In return for my paying taxes based upon today's fair market value, I'm not going to get taxed as and when the shares vest. Okay. So in our example, let's say the 500 shares are worth $1 a share. I recognize $500 as taxable income, pay the taxes on that, and then I don't have to worry about the shares as and when they vest over time. So the point here is it's really easy to make an 83B election when the shares have little to no value. It's a much more difficult decision to make an 83B election if you're receiving shares that actually have some value. And for that reason, stock grants are typically only made very early on the company when it has little to no value, or the employee is going to end up paying for those shares, right? If you pay fair market value, you're not going to recognize any income. Okay. All right. It's probably a good time to pause and see if we have any questions.
Yeah, I have a question. Are when you get taxed on purchasing a stock, is it or like in this scenario, like is it universal? Is there a universal rate or is it contingent to like where you're at locationally, or how does that work as well?
It's going to be exactly the way you recognize income today based upon cash, right? So in other words, if you're, for example, in California, you're going to include the income on your federal income tax return, which then depends upon what income bracket you're in, right? And then you're going to have to recognize the income on your state income tax return, and it's going to again depend upon what bracket, what deductions you have, etc. So the point here is it's treated exactly the same as cash consideration, based upon whatever the value is that you have to recognize.
Oh, gotcha. Is there another way where you can like, I don't know if you have like a, say, dual citizenship, um, or something of that nature, like, um, would you be able to recognize it under another jurisdiction, or is there any way around that, I guess?
There's not. I mean, even if you're a dual citizen, if you're working in the U.S. and it's basically income based, from the U.S., you're going to have to pay income taxes, as you normally would.
Makes sense. Okay.
Okay.
Thank you.
All right. Let's go ahead and continue. Um, so again, we're still talking about direct stock grants, which typically are restricted or unrestricted. And one of the issues is, how do you pay for it if you have to pay for it, right? Okay, so one thought here is you don't pay for it because it has no value, or you pay for it and it's a penny a share, right? And so it's so minor. But what if you're a more senior executive, the company's a little further along, and let's say there's actually some value here, right? So the point here is the plan and governance will kind of depend upon how you're going to pay for it. But you can pay all cash. You can, in some instances, use a promissory note. Just keep in mind that using a promissory note in some places is not adequate consideration to purchase stock unless it's secured by collateral other than the shares. You could also do a combination, right? Maybe you do a 20% in cash and the rest on a note, as long as the note's secured, or you can pay for it through services, canceled securities, intellectual property. Maybe you're going to contribute a patent to the company and that's consideration for the stock. And just a final note here that the 83B election can be challenged if the consideration consists of 80% more of a non-recourse note. Now, what I mean by that is that's a note that the company can't come back and actually enforce against you. And if you think about it, if you pay for stock with a note that the company can't then go back and enforce against you, it's really an option. In other words, you can decide downstream you really don't want the stock and you don't pay the note. So the IRS treats it as an option, and you'll kind of see how that's taxed downstream as well. But the point here is most people pay cash if there's anything. Some people can pay a promissory notes if it's collateralized. A lot of people, especially early stage formation, they get their stock by contributing property or assets to the corporation, in particular, intellectual property. Okay. Well, we talked about vesting, right? Vesting was important because that's how the restriction on the restricted shares lapses as it go away. So to earn the shares, how do they vest, right? And so you can be as creative as you like here. You could have, for example, the pure passage of time. Remember, we talked about in the example of 500 shares of XYZ Corp and how they would vest 100 shares a year over 5 years. That's pure time-based, right? In other words, as long as you stay with the company, as long as you pass the time with the company, your shares are going to go ahead and vest, okay? In the alternative, and some people don't like passage of time because it doesn't really incentivize people to work hard and do a good job. The counter argument would be is that the company's not going to keep you if you don't work hard and do a good job, right? Because vesting lapses when you basically leave the company, whether it's your choice or not. But some people prefer performance-based, right, to motivate people. Now, so you can come up with performance milestones. These milestones can be individual-based or company-based. So, for example, if I've got a hotshot salesperson who I'm hiring, maybe I'm going to tie their performance to, okay, maybe year one, you're going to vest 20%, if you have $1 million in sales. Year two, I'm going to hang the carrot out a little further. I need $5 million in sales, right? And so the point here is you can tie it to individual performance. On the other hand, you can tie it to company performance, right? Maybe I'm the CFO and I'm going to tie company performance, for example, to the company having, let's say $1 million of EBITDA for year one, right? And so we can try to motivate people differently based upon what their job and what we're expecting out of them. We can do a combination, right? In other words, for example, for the hotshot salesperson, I'm going to have set up individual performance milestones. And then I can say, hey, worst case, you're going to invest 10% a year over the next 10 years, right? In other words, I can have a fallback based upon passage of time if the person doesn't get it done for the personal milestones. But keep in mind, if you've got a salesperson who's not hitting their numbers, you may not very well decide to keep them anyhow, right? But the point here is you can be very creative in what you do with these. Now, what happens if the company is sold before a person has fully vested, right? That's where we typically have things called acceleration event vesting, right? In other words, that if the company sells, for example, that we're going to accelerate, we're going to vest all of your unvested shares. Now, there's some arguments against doing that. Why? Because it hurts the sale of the company, arguably, perhaps because the buyer is concerned that if the management team is fully accelerated and then made fat, dumb, and happy, right, because they've cashed out and they've made a lot of money, are they going to be motivated to work hard for me? And so it's a big concern of buyers when they come in to make sure that the management team is going to stick around, right? And so rather than have a single trigger acceleration, sale of the company, we're normally going to see something that's called a double trigger. And the double trigger says, you're going to fully vest, we're going to accelerate you if two things happen. One, the company sells, and two, the buyer doesn't want you. In other words, for example, maybe the buyer has their own CFO and they don't need your CFO. In that case, the buyer is going to let the CFO go. It's fair in that situation then to have the CFO accelerated so they cashed out because they worked hard before the sale. And it's unfair for them to be, cut off because this was the buyer's decision and not the seller's. So the point here is that we do want to provide for a situation where the company's sold before people have fully vested, and that's something that'll be typically dealt with through the governing documents. Typically, we would say for lower level rank and file type of employees, acceleration is not all that common. Acceleration tends to be much more common for senior executives and the management team. The purchase price. So what do people pay for the shares? And basically, I just have a note here saying that it's whatever the parties agree to, right? Whatever the value of the stock is. Are they paying fair market value? Are they getting a stock grant, in which case they might have ordinary income? There may be some securities requirements and tax issues that restrict what prices can be. So for example, sometimes people who own 10% of the stock have to pay 110% of the value of the company to avoid taxation. There's some, issues here, but a little bit too more detailed and nuanced for us to go into any more detail than that. Now, one of the issues is that when we give voting rights, when we give stock, what do we do with voting rights, right? And this can be a very tricky discussion. Imagine a situation where I've got a company and I'm a 50% owner, and Philip is my co-shareholder and he's 50% owner as well, right? And all of a sudden, JJ comes in and we're going to compensate him 5% of the equity, right? Now, what should I be thinking about here, right? So Philip and I, to this date, could block each other, right? Because we were both 50%. Now, what happened if JJ comes in and he sides with Phillips with everything? What have I just done? I've just created a situation where I have created and made JJ the swing vote. And so you have to be really careful and you have to think long and hard about how the equity incentives that you're giving to team members could affect voting control of the company. So in the situation that I'm talking about, I would probably want to think about using non-voting shares. And that way I'm not altering voting control of the company, right? So when you give stock, think about how you want to handle voting rights. You could give full voting rights at the time of purchase. If you do, you may want to have some protective provisions to protect the company, right? So for example, what happens if we have a sale, if Philip's selling some shares and, to a buyer, and Philip leaves me and JJ behind, right? Maybe we want the opportunity to cash out with him as well, right? Maybe he's selling 10% of shares, and maybe I want to sell 10% of my shares. So we would have what's called a tag-along right, where JJ and I have the right, not the obligation, but we have the right to jump in on that sale. Okay. And similarly, what happens if Philip and I, who have worked really hard, want to sell the company, but JJ refuses? And we don't want him holding up a sale transaction, right? So it's important to get what's called a drag along right, which basically says if a certain threshold of ownership of the company wants to sell, then we get to drag along people who may not be willing to, right? We're requiring them to agree to the sales transaction. So all I'm saying is that when you give out voting shares, you have to think long and hard about how it's going to affect the equity ownership and how people could hold up shares or be left behind when shares are being sold. You can also avoid these issues that we've talked about by having limitations on voting rights. So again, for example, we could use non-voting stock so we don't affect ownership. Now, you still may want to have a drag because you still may want to force them to sell their equity, but I'm not worried about them changing the voting control based upon the existing allocation of voting in the company. I could use voting shares and then require the person to give a proxy, right? And so maybe I'm going to give a proxy to me, right? Which shifts the voting control, right? So you don't necessarily want to do that, or Philip wouldn't necessarily want to do that. Maybe I can have JJ give a proxy to vote half the shares to me and half the shares to Philip, and that way we maintain, our pro rata ownership in the company. Also, we can have a shareholders or voting agreement, which basically says how all the shareholders and owners are going to vote. And I have a whole separate presentation based upon shareholders agreements, but the point here is it's a way to get people in advance to agree to how we're going to basically, allocate things out and preserve, the voting arrangement among folks. All right, that is direct stock grants. Quick, got it. And any questions before we move on to stock options? Okay, I'll move on to stock options. And the point here is we're going to start seeing some of these same topics and see how they're handled differently with options. Now, a stock option is not an ownership interest in the company, right? When we talked about stock grant, we talked about me having the stock certificate certifying that I was owner of the shares of the company, right? Stock options are not like that. Stock options are basically contracts that allows somebody to buy equity into the company over a period of time set out in the contract and based upon a price set out in the contract. So for example, and that contract being an option agreement. So for example, it might say that Bart is entitled to purchase 500 shares of XYZ Corporation, and the price will be $1 a share, and I've got 5 years to do it. Okay. And so in other words, I'm not actually owning them now, but I have the right to do so in the future based upon the parameters set out in the option agreement. So that's what we mean by a stock option. So when we talked about the direct stock grant, remember we talked about who can participate and who's eligible. And in the direct stock, we said it's usually individual based, but sometimes you can have a broad-based approach. It's typically the opposite with stock options because it's a tool that we use to basically compensate more people, right? And so plans are typically set up. Companies will have equity incentive plans, which allows the company to grant stock options to, typically any of the employees, consultants, directors, officers of the company. So typically broad-based. Sometimes they can be individual based, right? Sometimes we have companies or clients who don't have option plans and we just kind of do them on one-offs. But the point here is that we can have options under the plan on a broad-based approach, and we can have options outside the plan. Now, it's a little bit harder to do the one-offs through securities laws, but not insurmountable. But the point here is that's why you typically have companies with equity incentive plans, and that's what they use to grant stock options. So size of the option grant, all I'm going to say is it's typically left to the discretion of the board. There's not a lot of restrictions on who can get what. There are some statutory restrictions. If you give too much equity out, you have to get shareholder approval. But again, just going to kind of gloss over those things for now, but just kind of keep in mind that there could perhaps be limitations on how much equity you can give out through option plans. But it's really important for the board to evaluate the importance of the recipient and what percentage of the company they're going to get. And sometimes there's some very common road marks, right? Sometimes we see CEOs of more mature companies get 3 to 7% of the company. Maybe we're going to see the CFO get anywhere from 3 to 5%. Board members may get 0.25% to 0.5%. There's some fairly common rules of thumb here. But again, it's purely the discretion of the board based upon what's necessary to attract and retain the right people to the company. Now, much like when we talked about stock grants, we had restricted and unrestricted. In other words, 2 different types of stock grants and different tax consequences. We have 2 different types of stock options that we need to talk about. The first are incentive stock options. Incentive stock options, by definition, are those options that meet the requirements of Section 422 of the Internal Revenue Code. Okay, so if they do, they're incentive stock options, and if they don't, they're not qualified, okay, or non-incentive or disqualified stock. So incentive stock options, just a few keynotes here. Grantees have to be employees, which means you cannot give incentive stock options to directors unless they're also employees. You can't give them consultants or contractors. They have to be employees. The exercise price, in other words, how much they pay, has to be at fair market value. Okay. If you give an option below fair market value, in addition to some other adverse tax consequences, they cannot be incentive stock options. Okay. And again, there's other statutory requirements, but those are really the key main ones that we need to think about for purposes of the presentation. Everything else, if it's non-incentive stock option, is a non-qualified stock option. So let's talk about the tax treatment. For incentive stock options, these are the most tax-friendly for the recipient. Okay. At the time of the grant, there is no tax consequences to anybody. No tax deduction for the company, okay, and no income recognized by the employee. Because remember, these are being given at fair market value. If somebody has an option at fair market value, in other words, the right to buy a share for $100 that's worth $100, there's no upside yet, right? So it makes sense. There's no tax consequences. So neither the company or the individual is going to have a tax consequence at grant. The recipient will have capital gains treatment upon the sale of the stock, okay, assuming that they have exercised it and acquired it prior to that time. Potential AMT, alternative minimum tax liability, again, a little bit more detail than we need to talk about for this presentation. And what's also important to know is that if there's a disqualifying event, then it becomes a non-qualified stock option. So let's go through kind of a situation here so you can get a better understanding how this works. So imagine someone gets an option for 500 shares of XYZ Corporation, okay, and at the time of grant, no tax consequences. Let's imagine 2 years down the road that they exercise their vested part of those options, which was 200 shares. And let's imagine that the exercise price was $1. And let's go ahead and imagine that the fair market value of those shares at the time is $10. Because these are tax favored, the exercise of that option is a non-taxable event. Okay, even though there's income, in other words, even though there's a difference between exercise price and fair market value, because these are incentive stock options, there is no taxable event. Okay, and because of that, the only time that the person recognizes the taxes is when the company is sold, and then they're going to pay capital gains on their difference between their exercise price and fair market value. In the case of non-qualified stock options, okay, at grant, it could be a taxable event, okay, because unlike stock options, they don't have to be granted at fair market value. Now, again, there's some adverse tax consequences for doing it, which we're going to talk about. So it's rarely done, okay? But the situation is there is no tax, again, unless it's a fair market, the grant is done below fair market value. If it's done below fair market value, there can be a whole lot of adverse tax consequences. The person, however, unlike an incentive stock option, if and when they exercise the option, they're going to receive taxable income. So let's go back to our example of the 500 shares, $1 share exercise price. After 2 years, 200 shares vested. Person exercises 200 shares, which are now worth $10 each, right? So we have a $9 per share spread, right? Times 200 shares, we have $1,800 in taxable income, which will then be taxed to the recipient at ordinary income rates. If and when the person sells the shares and they've held it for a year to get the capital gains treatment, then they're going to pay the taxes at capital gain rates in excess of $10 a share. Okay, why? Because they've already paid the difference between the $1 and $10. So if the company sells for $100 a share, then they're going to only recognize capital gains at $90 a share, right? $100 a share less the $10, because again, they've already paid taxes on the difference between the 1 and the 10. Now, I mentioned there can be some really nasty tax consequences, and I just want to bring that up here just so you have a little bit of sensitivity. And so this is basically Rule 409A of the Internal Revenue Code, which taxes as present compensation deferred compensation. The reason why I'm bringing it up here is because stock options that are issued below fair market value are considered to be deferred compensation. So before 409A, it was very common for non-statutory or non-qualified stock options to be granted below fair market value. Since 409A, it's very rare, okay? But if they were, basically 409A taxes as current compensation the difference between the exercise price and fair market value. There's an additional 20% federal tax. There's an additional 10% California state tax, and then penalties and interest. The point here is that you could owe 70, 80, 90% in taxes of compensation that you've actually never received, okay? So I'm just bringing this up because 409A is very draconian. And for that reason, it's very unusual to see option grants below fair market value. And if you or your employer or you as an employee and someone is talking about giving you options below market, you need to be very, very careful and talk to an advisor because it could have some really nasty tax consequences. The exercise price, okay, in other words, how much you pay. Remember, we mentioned for incentive stock options, in order to meet the requirements and be considered an incentive stock option, they have to be granted at 100% fair market value. But there's a special rule that it has to be 100%, 110% of fair market value if the shareholder owns more than 10% of the company, okay? For non-qualified stock options, there is no restriction on what the exercise price can be. However, 409A makes it very unlikely that people are going to actually give them below fair market value. And some people may give them more than fair market value. Rare. Most people try to bullet, bad down on what fair market value is. But again, sometimes we have employers or clients who give the stock at more than fair market value. If you remember when we talked about restricted shares, that they would vest, which means when the restrictions would lapse. Okay, operates a little bit differently with stock options, but stock options too have to be earned. So, but unlike shares where you actually own them and then they're subject to forfeiture, for stock options, vesting means when can you exercise? When can you buy those shares? Much like we talked about before, that they can vest based upon the passage of time, right? 500 shares of XYZ Corporation, 100 shares a year over 5 years, that's 20% of your vesting, pure time-based. Can be individual performance-based, right? The hotshot salesperson who we have sales goals can vest based upon the person achieving or hitting those milestones. And lastly, can be tied to company performance. Did the company reach a certain EBITDA level, revenue level, or a certain number of clients for that year, right? Can all be tied to how the company's doing. Can be a combination of both. And much like we talked about in the stock grant case, what happens if the company's sold before the option is fully vested? We can have acceleration. Very unusual to have it for broad-based rank and file employees, much more typical for management team. But we can have either a single trigger, based upon just the sale of the company, but more typically double trigger, two things: sale of the company and the person is terminated or not hired by the buyer. How do we pay for the shares? And again, this is where we move a little more quickly because it's pretty much the same slide that we talked about before. Typically cash. You can have a note as long as the note is collateralized by things other than the shares. We can have other types of legal consideration, labor, services actually performed by the company, surrender of option shares. In other words, you can cancel some of the option shares, give the value back to the company. We can cancel debt. For example, if you loaned money to the company, we can have that canceled and use that as payment of shares. Or you can contribute property or intangible property like intellectual property to pay for the shares. Voting rights, again, very similar looking slide that we saw before. The point here is when you issue the options, you don't have to worry about it like we did with the stock because a person actually doesn't own the shares, right? But we do have to worry about it, what happens if and when people exercise the options. We can, use voting shares and have the protective provisions that we talked about before, tag-alongs, drag-alongs, or we can use non-voting shares, or we can use voting shares. And if somebody exercises the option, then we require them to exercise a proxy. Same issues. We can require that they sign up and become a party to a shareholder agreement. We can tie all these things together, much like we talked about in the portion dealing with stock grants. Okay. We've got a bit of a breather time before we talk about phantom stock and share appreciation rights, but any questions before I move on? Okay. And Philip, what time do we have for?
We have until the top of the hour.
Okay.
But I'm thinking maybe 10 minutes for Q&A or 15 minutes for Q&A.
Perfect. Yeah, we're gonna cover this in 5 minutes because unlike the other ones, phantom stocks, share appreciation's really easy, right? And then we'll have some time for Q&A. Okay. So we talked about direct stock grants where somebody actually owns shares in the company. We talked about stock options where someone doesn't own shares, but they have a contractual right to acquire them in the future based upon certain parameters. Phantom stock and share appreciation rights are basically a cash bonus plan that is tied to the appreciation the company shares. So the point that I want to make clear here is that it's a cash bonus plan. It's not equity. It will never be equity. Okay, so it's not equity like stock. It never will be equity like stock option plans, but it's a way of compensating people in cash, and how much they get is tied to the performance of the company shares. So for example, someone may get 100 phantom stock units, okay? And at the time that the person's hired, those units are worth $10 a share, $10 a unit, okay? If and when the company sells and those things are worth, $1 million a unit, all right, then they have, 10 units times a million less the threshold, right? Which was, $10 a unit. The point here is they would have the right to receive cash based upon that difference. So never equity, not equity, never will be equity, okay? It's just cash bonuses based upon how well the company stock has done. Eligibility and participation, typically individual based, right? These are complicated, and they tend to be fairly customized. We do have some clients who adopt, share appreciation plans. But I tend to see it used more for compensating employees in typically senior management in very rare and unusual circumstances. This is typically ideal for companies or employers who have been burned before. In other words, they may have had given out equity before and maybe somebody was litigious. The point here is we have this in situations where people have been burned, or we have situations where people are just concerned they want to own the whole pie, but they're willing to share the upside of the company, through a cash bonus. Tax treatment. So because this is just basically a grant of a cash bonus that will be paid in the future based upon certain parameters, at the time of grant of the award, there's no tax consequences. At payment, the company will have the compensation deduction, the employee will incur ordinary income. There's never an opportunity for capital gains because this is always a present cash bonus plan. Just a note here that we might have deferred compensation penalties tied to 409A. The point here is these things have to be done correctly, or they could violate 409A and trigger these really adverse tax consequences. Accounting treatment, the benefits must be entered as an expense as and when accrued, right? So for accrual-based companies, they have to look at how much benefit is being accrued on an annual basis. So these things could be basically compensation on the company's financial statements, accruing for these things over time, even though they're not paid. Exercise price, there's no exercise price, right? These are never equity, nothing's ever bought, so you don't have to worry about the exercise price concept. There's never payment for shares, right? There's no shares here, there's no payment. The person just gets cash equal to the difference between the unit value and fair market value at the time these things are basically rewarded, cashed out. Voting rights, we don't have to worry about voting rights. People never have equity, never have participation, never have to worry about these students voting and upsetting the voting rights of the company. Told you we'd get through these things quickly, right? So the point here is the share appreciations or phantom stock, kind of same name for the same things, solve a lot of the complicated, issues in having equity, but at the same time, they tend to be pretty complicated themselves. Anyhow, so leaves us with about 10, 15 minutes for questions. So why don't we see what you guys would like to dive into a little bit more detail or questions or pushbacks. Let's see where it goes from here.
Great. Thank you, Bart. This was very informative, and I think it really puts the idea about, how to incentivize people. A lot of people really don't even, they think about equity, but they don't really know the mechanics, and this is really helpful. I did see Sonia had quite a few questions in the chat. Sonia, I'm not sure if you want to take yourself off mute or have me read them. And then I also saw we have a few others as well. Let's see, John and Shelley as well. Would you prefer to feel free to unmute yourself and ask your questions? And if you want me to, then that's fine as well.
So, and we can run through those questions. I mean, I'm just going through the chat. So, so Sonia asked, what's the benefit of not doing the 83 option? So remember, the 83B option was to avoid the really nasty tax consequence of recognizing income every year the restrictions lapse, right? And so in a perfect world, you're always going to do the 83B election because you're going to prevent a really nasty tax consequence. The reason why you're not going to do the 83 option is that the cost of doing the 83B election is that you have to pay taxes based upon the fair market value of the shares you received. So if the shares you're receiving have value, the question is, do you want to make the 83B election if you're going to actually have to pay the taxes on those shares because the company may ultimately fail? And so why pay, the taxes on something where you may not ever realize the value? So the point here, and to answer Sonia's questions, is as those shares are more valuable based upon when you're receiving them, okay, not when the restrictions lapse, but as the grant is made, if they're worth too much to want to pay the taxes on, so the benefit of not doing the A3B is that you're not going to have to pay the present taxes on the value you receive. The cost of doing that is that you're going to have to pay the taxes when the restrictions lapse, which could be even worse. Let's see, I'm going to move down to, is this vesting equity, how private companies can say they are employed and owned? So when a person gets shares that are subject to risk of forfeiture and vesting, they're still owned. Okay, the person is a shareholder. Okay, the problem is if those shares, and again, I'm not talking about options, I'm talking about direct stock grants here, right? The person actually has the stock certificate, they own it. Okay, it's in their name. The problem is that upon certain events, if the shares have not been earned, in other words, if the restrictions haven't lapsed, those shares can be taken away, right? So let's imagine a situation where somebody has 500 shares of XYZ Corporation. The employee has worked for 2 years, 200 shares have lapsed, and then the employee leaves. The employee can keep the 200 shares. The 300 shares that they haven't earned, the company will buy them back at cost. They'll recapture them and take them away from the employee, okay? Which leaves the employee with the 200 shares, and then most employers are going to buy you out at fair market value, right? It's not a risk of forfeiture because you're getting fair market value, but most employers don't want to have, a bunch of employees who aren't engaged in working the company hold the equity anymore. So the point I want to make in response to Sonia's question is just because they're restricted doesn't mean that you don't own them. You do own them, okay? It just means that they're subject to a risk of forfeiture, okay? And they will then, because they own them, they will get dividends. They will get, again, we're talking about startups who usually don't pay dividends, but if it's a company that does, they'll have the voting rights and, if they're voting shares, and they'll have the right to receive dividends because they're treated as a full shareholder. So I'm moving on to Sam's question. Did you say you could pay for the note of shares using 80% using a promissory note? Collateralized with. So what I said is that when you pay for the stock, you can pay up to 80% of a promissory note, but that note has to be collateralized by things other than the shares. In other words, a mortgage on your home, okay? A security interest in your car, a security interest in a CD, right? The point is you have to pledge it with collateral that's worth the value of the shares. So for most people, they're not going to do that. But the point here is that that is an option.
See, I see Joseph has, Joseph, you have a question about this topic?
Hey guys, y'all hear me okay?
Yep.
Bart, thank you for your presentation. That was fantastic.
Thank you.
So I had a question about, co-founder equity splits. So usually if you have a co-founder, you start off, let's say 50-50, equal split. You and your friend decide to start a business, or someone an expert in the field. And then at some point you need to decide to, give equity away to other people and, individuals that join the organization, or anybody that's, investing in your company for equity. And so with that being said, I wonder, what would be the process for kind of like splitting that equity and pretty much, how do you say, dissolving some of the equity to give to other people? And as far as I'm not sure if have you used a SAFE before, simple agreement for future equity with investors?
Sure. So remember, safes are entirely different because they're not used to incentivize, team members, right? So a SAFE is really more of an investment mechanism, where these are basically, tools to, attract and retain team members. But I mean, I think if I understand your question, you may start out 50-50. You're usually not dissolving shares or giving shares back. Usually what you're doing is you're issuing new shares, right, on top of what you guys already own. And what I think it really comes down to is, kind of the caution from the presentation was you need to think very long and hard about how the new shares being issued are going to affect ownership.
Oh, I see. So you're diluting shares. That's what I meant to say, diluting.
Yeah. So in other words, you will be diluting, right? So if you're 50-50 and let's say you set up an option pool for 10%, on a fully diluted basis, the plan owns 10, and each of you owns the 45 and 45, right? But if none of those shares are actually issued, you're both 50-50 still, right? The thing you have to be careful about is what happens if one share is issued out of that plan, and how does that affect you guys, right? Now, if it's voting shares, it could be that person could be the swing vote. And if you guys, you and your co-founder aren't getting along, each of you is going to kind of try to attract that person's vote to break a deadlock. That's why I'm saying you may want to think long and hard about using non-voting shares to prevent that from happening. As much as a deadlock is a bad thing, but the risk of a deadlock is what may take for, Joseph and your co-founder to get to the table and work it out, right? So deadlocks can be bad, but at the same time, deadlocks can be beneficial because it's the one thing that's keeping you guys together to sit down and work things out.
I've heard that it's recommended sometimes for one of the co-founders to maintain, like, let's say 51%, to not, kind of be put in that position where, you can still make decisions. I wonder, like, from the investor standpoint, if that's actually true, if they are actually kind of looking to avoid those deadlocks and what measures you would take.
Well, keep in mind when the investor's coming in, it's going to change that structure, right? And, so I mean, even if you guys were deadlocked originally at 50-50, or even if you were 51-49, let's say you've got a preferred stock venture capital deal, and they're going to, let's say they take 30% of the company, it's now going to be 30 and you guys are going to split 35, right? They're the swing vote. And again, we have to, that's all the things that we have to think of. So I don't think you're ever going to find a situation once a sophisticated investor comes in that you have a deadlock situation. They're not going to invest in a situation where there's a deadlock situation. They're going to invest, they may come in even a 30% minority owner, but the point here is that, you guys are going to vote, and for the things that they care strongly about, they're going to have supermajority requirements, or they're going to require a say in the matter. So that's where a voting that's where a voting agreement comes in. So that, in other words, the risk to the venture capitalist is that you guys are going to gang up and vote against them on important material things. The VC is going to say, look, if we're putting the money in, we have to have a say in those material important things. So the dynamics change greatly when you bring in a sophisticated investor.
And do you have like if I look at I think it's called certificates part, I had an LLC formed a couple years ago. I recently, it's non-operational now, but the only doc of ownership, it pretty much is like this membership certificate where it says there's 100 shares, right here, and then my name, and then, just the date and signature. Do you have like a library of different forms of kind of like where we would pretty much issue equity in a different way, kind of like you're describing, where it's let's say a 4-year vested equity agreement?
So I'm going to push back here because that membership certificate is not the only thing that you have. Okay, if an LLC is actually duly and legally formed, it's going to have an operating agreement. The operating agreement is then going to have the rules of what the membership interests mean, who has what voting rights, and all these different types of things. To answer your question, if you have an LLC, by the way, LLCs cannot have stock options. Okay, so you're going to have something, you're going to have probably like with a restricted unit plan or something different. Okay, or you might have, there's various different ways to incentivize people in membership. All I'm saying is that the rules are a little bit different and you have to handle them differently. But you could, for example, have direct unit grants, which are going to be just like the direct stock grants that we talked about. But yeah, you're going to have completely separate, unique documentations to document each of those transactions.
Right on. Do you have a recommended like library of those documents and what they might look like?
I do not. There are some law firms that have forms. There are some, I think the National Venture Forum has documentation, but I'm not a big fan of form documents because when form documents are put into the hands of people who don't know what they're doing, it's garbage in, garbage out, right? And so people make mistakes because they take a form and they think they're protected, and then they can really be hurting themselves. So yeah, there are forms out there, and you can search the internet and find forms, but all I can tell you is don't do it. Unless you're a lawyer or you have somebody who knows what they're doing, because I mentioned a lot of the work we do is forming companies and cleaning up companies. I wear a janitor hat. I cleaned up a lot of bad little companies because of terrible mistakes they've made. And most of the time we can clean up companies, but there's some situations where you can't. A big mistake may have been made and a founder left, or the founder's no longer getting along, and I need their signature. And my client says there's no way they're going to sign anything. So people can create tremendous problems for themselves. So forms are good for forms for people know what they're doing, but 99% of the people don't.
So I'll fall in the category of people that don't know and should probably call a lawyer.
Yeah, I mean, I barely get along, and I did 30 years. No, I mean, the point here is that there's people here who make a living of this, and find yourself a good lawyer who can help you and represent your company and make sure that you guys don't get on the bad side of things.
Thank you, Bart.
Yep.
Bart, do we still have time for the other two questions in the chat? Okay, so John asked, what type of stock option abuses have you seen where what is being promised to rank and file employees is never delivered and only management reaps the benefits of the company sale? What protection exists for employees to ensure that they are treated fairly in the exit event?
Yeah, I mean, what I can tell you is if the stock options were properly written and documented, I don't ever recall a situation where I saw abuse, right? I mean, because everybody knew what the rules were and everyone played along. The places that I see abuse a lot is when they're not documented, right? This is a situation where a couple of guys drinking at a bar, one person says, I'm working on a startup, and the other person, says, hey, I'm a coder, and the other person, hey, can you come write code for me, blah, blah, blah. I'll give you 5% of the company. And then it's time to sell the company, and the coder says, hey, you promised me 10%. Well, I thought it was 5%, and look, they were both drunk and it was never reduced to writing. I've had those types of things hold up sales transactions for 30 days. And what I can tell you is 9 out of 10 times the company, the employer loses because it's their responsibility to make sure the I's are dotted, the T's are crossed. So I think, to answer the question, the abuse comes in when these things are not written. If the things are written, it's hard to abuse them. If they're not written, then it's a he said, she said. And usually the company loses because, again, the courts look at them. It's their obligation to make sure that there are no misunderstandings. Next question. Can an employee who will be part of the founding team but is not a founder, co-founder, be compensated with mostly equity plus a small salary that is below minimum wage? The answer is absolutely not. Okay. And it's a great question, and I'm glad you raised that. Is that we talked about these things as being a compensation gap filler to make sure that people who are coming in at below market salaries are kind of brought up to a more, market rate. But you cannot use equity and stock options to satisfy minimum wage and other pay requirements. Okay. You have to pay people minimum wages, and it has to be in cash. Okay. And the point here is you cannot use equity to make up for not paying someone minimum wage. And to that end, make sure you're also giving people proper meal breaks and other statutory breaks, overtime if they're entitled to overtime, and all that type of stuff. Let's see.
And it looks like Shelly added a little bit extra.
Yep. Let's see. All right, let me read Shelly's question. So yes, in fact, not only can independent contractors may be paid with non-quals, they have to be, right? If you're using a stock option, it can't be incentive because that's only given to employees. You're not clear as to how that person is going to be clarified as in a contractor or employee. The short answer is nobody is. So this is a very tough issue, especially in California. What I'll start with is that the presumption in California is that people you hire are employees. And it is your responsibility as the employer to determine whether or not they're properly categorized as an employee or a contractor. The rules have been changing dramatically in California. There was a court case about 6-7 years ago that led to a new law adopted in California. That law was challenged. A proposition came in to accept out certain classes, in other words, rideshare companies and other professionals, and that proposition was declared unconstitutional. So the law is in great flux. What I can tell you, the takeaway is, at least under the current law right now, is that the standard used to be whether or not the person was responsible for how they did their job. Okay, in other words, if you're the employer, you're going to tell them how to do the job. If they're a contractor, you'll tell them what the task is, but it's up to them as to how they do their job. That was the rule for years. Then this case came along that basically had a 3-set criteria. Number one, they have to have discretion on how they do their job. Number two, they have to have other jobs like your job. In other words, they can't be working exclusively for you. And here's the most important one. If what they're doing is your product or service offering, then they can't be a contractor. So if you're Baskin Robbins and the person's scooping ice cream and serving it to your customers, they're an employee. Okay. If I hire somebody, an outside party, to do my books, they can be a contractor because that's not my product or serving to customers. The issue where this came about was rideshare. Okay. Uber hired, all Uber workers are basically contractors, okay? But under this new standard, are these people delivering the deliverable product or services of Uber, rideshare? And people said, yeah, that's what Uber does, rideshare. No, Uber said, no, we don't deliver rideshares. That's not our product or offering. Our product or offering is we're a platform to hook up buyers, riders with drivers. And so that's the reason why the exception came out in the proposition, which has now been declared unconstitutional. So a lot depends upon how you frame the question of what exactly your company does, right? But the point here is that if you're hiring people to do the products or services that your company offers to the public, it's going to be really hard to categorize them as an independent contractor, okay, under the new standards. There are tons of internal revenue regulations about like when a software developer who works at home is an employee or a contractor. I mean, I'd have to direct you to those, but this is not an easy issue, and it's very, very case specific.
Wonderful, thank you. I think that covered all those questions in the chat. Of course, if you have additional questions, please contact Bart at his law firm, Pivotal Law Firm. We have Bart's phone number and email, as well as his website. And I want to just say again, thank you so much, Bart. I really appreciated your presentation, your wealth of knowledge, sharing it with us all. And I think this really helps a lot of people. So thank you.
My pleasure, thanks. And just reemphasize, feel free to reach out. There's never a charge, especially now that I'm retired, reach out to me. I'm basically here to help connect you guys with people who can help move your businesses along, and just let me know you're on the presentation and you have a question to ask, and I'll get back to you reasonably quickly.
Thank you, Bart.
All right. Thank you, everybody.
Thank you, Bart.